Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Friday, end of the week. Markets, of course, are in wait and watch mode. No real catalyst in that sense. And I think yesterday's close perfectly symbolized that. Off the lows, but didn't know where to go. I'm Prashant. With me, my colleagues Mangalam and Reema. Guys, hi, morning.
Hi, morning. We don't have much to show for the week. In the last 5 days, the Nifty is up only 11 points. And for the last 7 trading sessions, we've closed between that 23,600 to 23,700. So,
yep, that's what we're going to do. Irrespective of the news, if you just followed the price, you would know that as we move towards 23,300, there is a bounce invariably. And as we move towards 23,800, there is supply. But be that as it may, the thing that stood out for me yesterday overnight was what Walmart's commentary said. And typically, Walmart's price action as a ratio to all the other luxury companies in the US, that suggests that there could be economic slowdown. Because every time the Walmart market cap as a ratio to all the other luxury goods market cap goes higher to a certain level, it indicates some slowdown. And the last time it was at these levels was, despite the 7% downtick, was closer to 2008. Don't want to say that, but that's what it was.
Okay, well, basically people down trading and buying cheaper in that sense. Well, we'll track that and more. Let's just take it from the top in terms of what you need to know as we start this new session. Oil's at $105 odd dollars a barrel, 104, 105. So hopes are for US-Iran agreement soon. Soon is the critical bit. How soon? Iran said that the latest US proposal, and this is important because, we keep hearing from US's side and there could be this, there could be that, either or, etc., etc. It's always, this is possible, but that is also possible. But, we don't hear that much from the Iranian side. But we did. Bloomberg carried a report quoting top Iranian government officials saying that the latest US proposal partly bridged the gap between both sides. So, and I think that's what got markets a little excited. And I'll come to price action in a bit. By the way, between when we closed yesterday and, US markets traded, there were reports that Iran, and this came earlier actually, that Iran is, the Iran supreme leader has ordered that enriched uranium has to be within Iran. And, prices spiked. Oil prices, I think, went up about 2-3% or so. This all happened while we were closed and US was yet to start trading. But that report was later denied. It didn't last. The price action did not last. Apparently, Iran is discussing with Oman, which is essentially the country, facing it across the Persian Gulf, and discussing how to set up some form of a permanent toll system over the Strait of Hormuz. This is, they got a Twitter handle going. That's a start. But how will it work and how will it happen and all of that stuff, right? Apparently, Iran is discussing this with Oman. Of course, the US has said this is unacceptable. Trump has rejected the idea, and we've got it on tape. We'll play it in a bit. We want it open. We want it free. We don't want any tolls to be expected. Now, US equities rallied into close. The S&P, by the way, it was down, and then it picked up from there, 0.17% higher. NVIDIA was down 1.8. Walmart was down 7% on weaker forecasts. So that's the price action there. The 10-year lost 2 basis points, not very much, 4.5% or so. By the way, US Treasuries market closed later today on Friday. Monday, of course, markets are shut. Memorial Day in the US, so US markets are out. So that's the global picture. So we are still in the state, which is no war, no peace. It's a stalemate, and we're waiting for something to happen, something to move. And that's essentially what the price action is indicating. So markets are refusing to stay down. But, after a certain point, they don't know whether they should go up. Rupee, by the way, is rebounded to 96.20. And by the way, this has happened over a 24-hour period. The low was almost 97. From the brink of 97, we are back at about 96.20, which is quite impressive. There was that swap which was announced, but that's not the whole of it. There was, of course, the oil price fall of about 5%, which I think helped at the margin. It came around the 96.90 kind of level. So then, that got pushed back. And markets, of course, are still waiting for what else we will see. There was a story yesterday that everything is under consideration, bonds, deposit scheme, etc., etc. Now, Nifty needs to get past 23. The levels remain the same. You know, the only thing which has happened is the range was higher earlier. On the upside, 24,300 was the level on the upside and 23,800 on the downside. So the market kept flitting between these levels for a while. Now it's basically down. 23,300 on the downside and 23,800 is the upper end of this particular new range, which is shifted a little lower. So we need to get past 23,800 for anything good to come out of it. And of course, on the downside, 23,300 should be the support. 23 points. It's a flattish kind of start for what's been a flattish kind of week for indices so far. Mangalam has walked across the wall with the futures and options positioning and how to look at it. Mangalam, over to you.
Well, if you look at the news and then you look at the price moves, you would realize that the Nifty over the last couple of weeks has been oscillating in this 23,250 to 23,850 sort of range. Why do I say that? Just look at the market moves over the last couple of weeks. On May 13, May 18th and May 20th, the day's low, 23,262, 23,317, 23,397. From these levels, there was a recovery of anywhere between 150 to 330 points. Now, as we moved higher, if you had the days like May 14, May 15, yesterday as well, and May 19th, as soon as the market moved towards 23,777 or beyond 23,750, closer to 23,850. From those levels, we've seen a decline anywhere between 80 to yesterday 200 points as well. So it is this range which is playing out. What makes the market break down or break out of this range? It is this troika. Brent currently holding around 105 right now, no problems. Rupee has strengthened from levels closer to 97 and the US bond yields. So these are the three things that can move the market out or, above or below this range that we're in right now. The other factor is that the Nifty is just very close to its technical resistances, just unable to pass that. Why do I say that? Because the Nifty 23,654 and you have the 50-day moving average at 23,700, the 20-day moving average at 23,892. Now look at all the three major movers of the Nifty, the major components. The Nifty Bank, 53,439, just 200 points from here. We have, the 50-day moving average, a little more than that. We have the 20-day moving average as well. So slightly higher levels on the Nifty Bank, we have technical resistances. The IT index, 2921. We have the 20-day moving average, which is just crossed, and the 50-day moving average is about 600 points from here on as well. So as the IT index moves or as the Nifty Bank moves, we have resistances coming in there as well. And finally, the third element, Reliance. 1350 is the stock price. 1376 and 1385 are both the 50 and the 20-day moving averages. So Nifty very close to technical resistance and three of its components also very close to technical resistances. Either of them move out and then we see the markets moving higher. And that's perhaps the reason why the FIs continue to sell this market right now. Yesterday as well, close to around 1350 crores sold in index futures. Their long positions have been at 12%. In fact, over the last three trading sessions, they've added nearly 22,000 short contracts for just about 800 long contracts. And their net exposure at negative 2.3 lakh contracts is closer to what we've seen at the lower level for this market itself. If there is any up move, there is ample fuel for the market to rally up ahead as well. Just a final thing, if you look at the options data, 23,800 call, premium of 100 rupees, 23,700 put, premium of 200 rupees. What does this give you the range? Between 23,500 to 23,900. So is the options data telling you that the support for the market has moved higher and the resistance also moved towards 23,900? Perhaps yes. The two stocks that I'll be watching out for today, and as a result of which the entire pack of all the new age listed companies are Nykaa and Honasa. Both of them have reported their best ever performance since listing. The stocks are well off their post-listing highs. So let's see where they go. I'm expecting an up move on these stocks, but more importantly, the entire new age company pack.
Thank you very much for that. Let's get back then to the developments from West Asia. U.S. Secretary of State Marco Rubio says there are some good signs as mediated peace talks with Iran are progressing, but added that U.S. President Donald Trump has made it clear other options are available if a deal is not reached. Listen in.
I believe the Pakistanis will be traveling to Tehran today, so hopefully that will advance this further. The president's preference is to do a good deal. That's his preference. It's always been his preference. If we can get a good deal done, that would be great. I'm not here to tell you that it's going to happen for sure, but I'm here to tell you that we're going to do everything we can to see if we can get one. But if we can't get a good deal, the president's been clear. He has other options. I'm not going to elaborate on what those are, but everybody knows what those are. But his preference is always a deal. His preference is always an agreement. His preference is always diplomacy. So let's see if we can get there. There's some good signs, but we understand this. I don't want to be overly optimistic as well. So let's see what happens over the next few days.
And on the Strait of Hormuz, U.S. President said he wanted the tolls to be taken out and added that no ship would go through Iran without U.S.'s approval. The U.S. Secretary of State also backed Trump's comments, saying that no one was in favor of a tolling system. The president's comments come even as Iran creates a new Persian Gulf Strait Authority to control maritime activity at the Strait of Hormuz. Listen in to what Trump had to say.
Well, we want it open. We want it free. We don't want tolls. It's international. It's an international waterway. They're not charging tolls. Right now, they are losing $500 million a day is what it's projected. I don't know, it sounds like a lot of money, but whether it's 500 or 200 or 300, they're losing a lot of money. There hasn't been a ship that's been able to get through without our approval. And the Navy has done an amazing job. And no ship is going to Iran, as you know. No ship is going to, or out of Iran without our approval.
Okay, well, that's the Strait of Hormuz story, right? But you heard Secretary of State Marco Rubio earlier on the Iran situation, but Rubio is headed here to India. This is the U.S. Secretary of State's first visit to New Delhi. Marco Rubio said that Washington wants to sell India as much energy as they'll buy as uncertainty grows over disruptions, of course, in the Strait. Listen into some of his comments.
Well, we want to sell them as much energy as they'll buy. And obviously, you've seen, I think we're at historic levels of U.S. production and U.S. export. We want to be able to do more. We were already in talks with them to do more. We want it to be a bigger part of their portfolio. We also think there's opportunities with Venezuelan oil. In fact, it's my understanding that the interim president of Venezuela will be traveling to India next week as well. So there's opportunities. There's a lot to work on with India. They're a great ally, a great partner. We do a lot of good work with them. And so it is an important trip. I'm glad we're able to do it because I think there'll be a lot for us to talk about. And we'll also meet with the Quad there, which is important. It's something, I think my first meeting as Secretary of State was with the Quad. So I believe like I got sworn in, I did the thing in the lobby, and then I went right upstairs, and that was my first meeting. And I'm glad we were able to do it now in India, and we're going to do one later in the year as well.
Okay, well, that'll be an interesting visit, the Secretary of State visit to India. There was a bit about the trade agreement, etc., as well, and how teams are going to be visiting each other over the next 1 month, etc. But nevertheless, we'll watch it closely. Now, let's welcome in our first voice on the program, global as always. Aditya Bhave is head of U.S. economics at BofA Global Research. Aditya, great to have you with us here on the program. Thanks very much for joining us. And I want to just start with what happened earlier this week. It's cooled off since, but global bond yields, right, and the move they've made the consensus view is that the energy shock is temporary, but markets are repricing higher, or at least trying to. Is this going to be sustainable, you think? What's it led by?
Thanks for having me on. I think it's a combination of factors that are driving yields up. The first one, obviously, as you mentioned, is the energy shock and the expected impact on inflation, both for the headline, which presumably will be a little bit less sticky but larger, and then also for the core, where the impact could come with a little bit of a lag and it'll be a little bit smaller, but at the same time, those sorts of shocks can be a little bit sticky sometimes. So it's that, but it's also just broad concerns around deficits across developed markets. Basically, there's a demographic problem across DM, across the world, and that's bad for deficits, and there are no clear solutions right now. So I think those two factors are driving the front end and the back end of global rates, respectively.
Aditya, hi. Thanks for joining in. So what's the house view in terms of where we are headed? The US 10-year and the 30-year yields, say by the end of 2026 or through 2026?
The house view from our rate strategists is that the 10-year will stay around 4.25% essentially for the next couple of years. The risks to that, especially in the last several weeks, are to the upside. It depends on several factors, right? It depends on how we're thinking about long-term inflation expectations. I think long-term expectations have remained relatively anchored. And from my perspective, that's probably because there is this underlying faith in markets that regardless of what's going on in the Middle East right now, a few years down the line, the big story is going to be the productivity boom from AI, and that's going to be disinflationary. So long-term inflation expectations haven't really moved. I think what's happening right now is the re-rating of neutral rates. Right? So is it the case that the neutral rate in the US isn't 3%, as the Fed has been saying, but rather it's 3.5%, 4%? We are quite sympathetic to that view. So from that perspective, if your real rate essentially moves up to, let's call it 1.5%, 2%, then that's going to push up long-term yields.
Right. So what does the Fed do in response to all of this? That's the basic question.
We think the Fed sits on its hands for as long as it possibly can until its hands are really forced by the data. So the challenge for the Fed right now is that the breadth of shocks that the US economy is facing is truly unprecedented. So on the supply side, you're dealing with the conflict in the Middle East, you're dealing with the labor supply story because of changes in immigration policy. You're dealing with tariffs, which are still not fully resolved. You also have a positive supply shock in the pipeline from adoption of AI, as we talked about earlier. And then on the demand side, fiscal stimulus is working its way through the economy, and you have the AI investment boom. So if you look at the recent data, they've obviously been quite resilient. Markets have moved from, I would say, a narrative of stagflation to a narrative of reflation, so more of a demand boom type story. Consistent with what you're seeing in corporate earnings, consistent with what you're seeing in the resilience of consumer spending. But we knew we were going to get some strength in spending from fiscal stimulus. So I think the true test of the resilience of the economy is still down the line. It may be more of a story for the late spring or even the summer, maybe even the early fall, because these shocks tend to work their way through consumer spending somewhat slowly. I would say the Fed still doesn't know, doesn't have conviction on whether this is stagflation or reflation, and the policy responses to those are obviously different. So for now, they just wait and see.
Aditya, the new Fed chair will take over soon, right? Where and which asset class does this show up in a pronounced way first?
His recent comments have been very dovish, which is interesting. Historically, he's been quite a staunch inflation hawk, but of late, he's made the case that the Fed should be cutting rates, that perhaps it's overreacting right now to the error it made in 2021, 22, where it was a bit slow to raise rates. He's also said that the Fed should look ahead to the productivity shock that we were talking about, the boom in productivity that's presumably down the line. And to accommodate that, since we know it's going to be disinflationary, the Fed should cut rates. Now, these arguments have gotten a lot more challenging given the increase in inflation. I think the rest of the committee really has no appetite to cut rates right now. I don't know even if Warsh wants to cut rates right now, because the environment has changed so much since he was nominated. The 10-year yield is up about 30 to 40 basis points since he got nominated. The 2-year yield is up more than 50 basis points. We've gone from pricing cuts to pricing hikes. So I think the world in which we last heard from him, which was really before his nomination, would be very different from the world that he inherits on Friday or when he gives his first speech or press conference or whatever. So there's a good amount of uncertainty. I think that there's going to be, his first speech is going to be a big market mover because we're all waiting to learn from him, you know, what he wants to do now after the conflict in the Middle East started. The other thing I should mention is his views on the balance sheet. He wants to cut the balance sheet. He realizes that's going to be quite challenging, and they only will be able to do it to the extent that they can do liquidity deregulations. But he has also said that he wants to move the composition of the balance sheet into Treasury bills, so front-end instruments, and get the Fed out of longer-end instruments, which I think there is actually a good amount of support on the committee for.
Aditya, we'll leave it there. Good speaking with you. Thank you very much, and good luck with the conference. This is just, I mean, you know, the first of the many conversations you will see here on CNBC-TV18 with the BOFA team. Thank you once again. Well, let me just quickly run you through the interactions which are lined up here on the program. 8:35, we've got the management of Ixigo joining us to talk about the business environment, which is also looking a little tougher, I guess, but Alok Bajpai will be with us to talk about that. 9 o'clock, we'll have Rajesh Ravi of HDFC Securities. Cement and Focus as a deal there as well. 920, Rana Gupta, Manulife Investment Management is the market master. 940, VA Tech Vabag, interesting company always. We'll get them. We'll ask them where the new orders coming from. Management of Healthcare Global Enterprises will be with us at 9:50 on their fourth quarter numbers and outlook. And Lata will be speaking with us. Lata will be, of course, hosting the Indianomics segment with Anand Narayan and Mridul Sagar on, of course, what else? But what the market is waiting for with regards to measures to defend the rupee, and if something will come, something is imminent. That's the lineup.
Indeed, and we'll take a short break, but a lot of stock-specific action that we have to track today. We'll get to it in just a bit in our special Top 10 segment. But for a quick peek, we have Maruti Suzuki, Dalmia Bharat, Aurobindo Pharma, LIC, Honasa Consumer, Nykaa and Paytm. All of them on the back of positive news flow. On the back of negative news flow, we have Max Healthcare, GAIL and LG Electronics.
Welcome back. It's a Friday morning. It's time to talk about stocks. Our entire research team is standing by with CNBC-TV18's list of top stocks for the day. Let's begin with Maruti. Hi, guys. Good morning. But Sudarshan, price hikes on the anvil for Maruti?
There was an indication in the analyst call that we had got from Maruti that they will be announcing price hike very soon, and finally company has come out and announced price hike, and that is up to rupees 30,000 effective from June of 2026. And now this is done amid rising input cost. Remember, in Q4 also the increased input cost had impacted EBIT margin of the company by 80 basis points. So to pass on the certain extent of those commodity costs, company has gone ahead to increase the prices by up to rupees 30,000, so might be taken positively. That's the reason I'm going with green for Maruti.
Okay, well, thanks very much for that. Dalmia Bharat is what we want to address, and it's back to you.
So remember, Adani Group had acquired JPSOC assets under IBC, that is Insolvency and Bankruptcy Code, and now this Dalmia Bharat, earlier also they had tried acquiring certain assets of JPSOC. Now for the second time they have got lucky, and now they are acquiring around 4 plants. One of them is Madhya Pradesh, remaining 3 are in Uttar Pradesh, and they will be acquiring, and that's including capex. Deal value is $67 per ton. Financing will be done via mix of debt, internal accrual, and timeline is within next 2 weeks. So what all they will get? So total capacity of cement 5.2 MTPA, that is million tons per annum, and clinker capacity of 3.3 million tons per annum, and enterprise value of the deal is 2,850 crore rupees. Now, why is it positive for Dalmia Bharat? Because it gets an access to central markets, moves towards becoming a pan-India player, and the total capacity is going to rise to 66.7 million tons per annum by Q2 or Q3 of FY28. So overall, it's looking positive for Dalmia Bharat.
Right, Sudarshan, thanks a lot for that. So this deal positive for Dalmia Bharat. Let's go across to Ekta. Max Health, how are the numbers?
Well, a bit subdued this time round. So the revenue was up around 10-odd%. The margins dipped on a year-on-year basis, and the profit came in at a 3% growth. The share of oncology dropped to 21% versus 26% due to the discontinuation of select chemo drugs for their institutional patients. Margins were lower because clinician costs went up around 230 basis points year-on-year. What did work was that the EBITDA per bed saw a Q-on-Q improvement this time. Max Labs revenue was up around 14-odd%, and Max at Home revenue was up around 30% on a year-on-year basis. More details at 11 a.m. when they do have their call.
Thank you very much for that. Over to Sonal now for GAIL.
Well, GAIL reported what was a weak set. Yes, weakness was expected, but it was even weaker than expectations. On a quarter-on-quarter basis, yes, revenues are up 2%, but a sharp fall in EBITDA, down around 56%. Margins halved on a quarter-on-quarter basis. Profits are also down 21% to come at 1262 crore rupees. The force majeure announced by a lot of these gas-producing companies is something that hit profitability for GAIL. That's why the natural gas marketing loss came in higher at 151 crore rupees. This has largely been a profit-making segment for the company. Gas transmission did well, 1881 crore rupees, because there was a tariff hike as well that came by. but the petchem loss continued at 377 crore rupees. Going with red because the gas supply issues continue, but of course we'll get more clarity from the management on the conference call.
Take that point, Sonal. Thanks a lot for that. Let's go back to Ekta. Ekta, Aurobindo Pharma, numbers slightly better.
Largely in line with estimates, you would have to say. Revenue up around 5.6%. Street was anticipating a 4% growth. Margins came in at 19.2% versus expectations of around 19.9%. And the profit came in at 920 crores. Street was anticipating 916 crores. US was down 13%, which was expected because they don't have Revlimid generic in terms of the amount of competition. It's increased a lot for that drug. EU was up around 30-odd%, so that did very well. Growth markets was up around 25% for the company this time round as well. Call at 8:30 a.m. Based on just these numbers, I expect the stock to be in the green, but the commentary will obviously change the trajectory.
Thank you very much for that. Yash, LIC?
Well, the numbers for LIC seem to be very strong for the fourth quarter. On all parameters, of course, the numbers have been much ahead of the street estimates, ahead of the CNBC-TV18 poll. On a year-on-year basis, also, the numbers have shown a very strong growth. New business premium growing by about 20%. It's a beat to CNBC-TV18 poll. Total AP growing by 22%. Again, a beat on CNBC-TV18 poll. Group AP growing by about 36%. Retail AP by 16% growth. Both coming ahead of CNBC-TV18 poll. VNB is shown a very strong growth, about 67% growth, and margins growing by nearly 700 basis points. On the margins particularly, the expectation was 21.26%. What the company has delivered is 25.66%. So a top-down beat, of course, top line doing really well in terms of AP and retail AP and group AP growth, and the quality of the business also, VNB and margins doing very well. The stock hasn't done anything in the last 3 months. It's down about 10% in the last 3 months, flat in the last 1 month. I expect the stock to be in green today on these strong set of numbers.
Thank you. It's not done anything in the last 1 year. It's down nearly 5%. But Yash, thank you very much for that. Upasana joins in for more on LG Electronics.
Well, overall, it was a weak quarter for the company. Revenue was largely in line, but the margins and PAT stood much below than what the street was anticipating. Now, if I talk about Q4 revenue growth, it stands at 8%, which was driven by demand recovery across the segments, which was much in line with the guidance provided by the company, that is high single digit to double digit after Q3. Home appliances, the key segment of the companies where the key drag comes from. Here, the revenue growth stands at just about 6%, while home entertainment has delivered a strong growth of 20% on year-on-year, driven by the rising demand for high-end TVs on the back of the IPL, which certainly spurred the demand. Now, coming to the margins of the company, the margins were under pressure, 230 bips down at 11.7% due to elevated prices and even currency fluctuation. Now, again, this is much lower than the implied margin guidance given by the company, which is around 12.5 to 13.5%. Now, overall, if I talk about of the FY26 numbers, the revenue stood flat, much in line with the guidance, and EBITDA margins here is under pressure at 9.8% versus 12.8% versus the guidance of low double digit given by the company. So, going with a red on this one on the back of weak margins.
All right, Upasana, thanks a lot for that. I'm looking at Honasa, good results coming in. In fact, the operating leverage has finally begun to show. They've reported their highest EBITDA and net profit since listing. Street was anticipating that the stock has seen a rally in the recent past. 23% revenue growth, gross margins maintaining. Look at the EBITDA. That's actually seen a near 200% growth from 27 crores all the way up to 77 crores. And we've seen the profit after tax as a result of which jumping from 25 crores to 69 crores as well. Even the internals, the underlying volume growth coming in at around 30%. Ad spends as a percentage of sales have reduced. Other expenses have reduced. So that's operating leverage coming in. And adjusted revenue, the company says, is higher by 28% if you account for the change in revenue recognition by one of their clients, Flipkart that is. Mamaearth reported teens growth. The younger brands grew by about 40%. So going with green on Honasa. Similar is the case for Nykaa as well. If you look at Nykaa, Jeffries calls it a flawless beauty. Well, 28% revenue growth, 67% EBITDA growth, margins expanding by nearly 200 basis points, and the net profit nearly quadrupling from 20 crores all the way up to 80 crores. You will have to call it flawless beauty because, the beauty segment, 27% revenue growth, 50% EBITDA growth. So margins have improved out there. Fashion, which was supposed to be, a business where operating leverage would start kicking in, their losses have narrowed from 36 crores to about 8 crores. So that's a positive as well. And their own brands have done a lot better, crossed 3,176 crores in revenue for this entire year in gross merchandise value. So all these factors point towards green for both Honasa as well as Nykaa. Remember, both these new age companies have been off their post-listing highs by a bit as well. So see some, confidence coming back to these stocks.
I think easier to title a report on Nykaa, right? I mean, lots you can do with wordplay there. Flawless beauty.
Flawless beauty. Even for Honasa, you can say that.
All right. Well, let's talk about Paytm now, right? And Sud is back with us. Sud's got a heavy load today. Block deal, Sud?
So the book is likely launched to sell the shares in Paytm or say 197 Communications, and this is launched by SAF Partner, which holds more than 13% stake as of March shareholding pattern. And now they are selling 86 lakh shares. That forms 1.3% equity. Deal value is 960 crore and floor price is rupees 1120.65 per share, which is a discount of 3% to current market price. And lock-in period is 30-day. But I'm going with green because the deal or say block deal is likely to happen in block window.
Okay, thank you very much for that. And lots of other stocks also you should keep in your radar, like Varun Beverages or even some of these PSU banks like IOB Central Bank, where they are looking at some fundraise. But let's talk about commodities now. Manisha is joining in with a complete roundup. Manisha.
Thank you so much for that. I'll start with the crude oil prices, where we've seen a bit of a rebound coming in yet again. Overnight was 2% of a decline, and with that, for this week, the crude prices are down by nearly 4%. Contradicting statements coming in from US and Iran, especially Iran, which is ordering enriched uranium reserves to remain in the country. Iran is also reportedly working with Oman on a framework for a permanent toll system at Strait of Hormuz. It's something that is keeping the prices higher yet again. $100 a barrel has been holding for a long time now. And if you look at the current quarter average, well, that comes in at around $105. So that is where we are looking at into the markets there. So while the crude oil prices headed for a negative week, it clearly is a similar matter for most of the metal prices also. Gold is down 2% for the week, silver down 4.5%. And since the West Asia conflict, gold has declined by 14%, while silver is down 20% as well. Copper prices continue to trade quite choppy. The prices have been under pressure as peace agreement between US and Iran wanes. But the rally in AI stocks and expectation that the renewables will see stronger demand going forward is what is keeping copper prices not too far away from its all-time highs.
All right. Thanks very much, Manisha, for that. Well, the RBI is not considering any off-cycle meeting, and it is not particularly inclined to use interest rates, a hike in interest rates to defend the currency, the rupee that is. Sources close to the RBI told CNBC-TV18. Lata is here with details on what she's picked up. Lata, over to you.
Well, exactly. There's a lot of speculation in the market whether the Reserve Bank, the rapid growth from 96 to 97 will lead to an off-cycle meeting. The source, who's very close to the Reserve Bank, emphatically said there's no such plan. In fact, he went on to say that the Reserve Bank is not even inclined to use rates as an instrument to defend the currency just yet. I mean, things can always happen in the future, but right now, the mood in the Reserve Bank, according to him, is not at all like that. The FIT, the Flexible Inflation Targeting Framework itself, requires the Reserve Bank to keep CPI at 4% plus or minus 2% and to ensure growth is normal. So it clearly does not look at it looks at using rates only for inflation. And where are the inflation numbers? The last number we got in April was 3.48, if anything below the 4% mark. And even the RBI's forecast for the full year, FY27, is 4.6. Again, very close to the range, well within the range and very close to the target number. In fact, if you go to FY28, the base effect of 27 can actually keep FY28 even lower, the source said. And then he also pointed out to the RBI's MPR, which is the monetary policy report they put out just before the April policy. That MPR, as you know, has scenarios. In a scenario of $95 average crude price for FY27, RBI sees CPI averaging 5%. Again, within the 2 to 6% range. And they envisage growth at 6.7%, not a bad number. The source also pointed out to what the Reserve Bank said as recently, the Reserve Bank governor said as recently as May 18th at the IMF, he said the Reserve Bank normally looks through the first round of price hikes if it is because of a supply shock, which is what the Hormuz Strait closure is, a supply shock. The governor went on to say we tighten monetary policy, that is, we hike rates, only when the first price hike leads to rise in wages and therefore rise in transportation costs, a generalized rise in inflation. Only then the interest rate instrument is used. And he also pointed out that actually in April, when the RBI met, the war was already on and the minutes sounded largely dovish. So he argued very strongly that the Reserve Bank's mood at the moment is not to use rate hikes to defend the rupee.
Now, there's just one thing. So the rupee went to almost 97, right? And it's come back to about 96.20. So it's a sharp rebound. Is this RBI supplying dollars? Is this what's going on? This move, this rebound, I mean, that we've seen. And I think in the intervening period, we had that 5% cool off in oil as well. So that is the global thing. But from a local perspective, what's been happening?
What we heard, I mean, this cannot, the PSU banks who intervene on behalf of RBI are sworn to strict secrecy. So they don't let it out. But the expectation or the chatter in the market was that Reserve Bank was also there. But people were anyway cutting long dollar positions because of the global news. After all, from 110 to 105, 104, a fall in crude was good enough for some people to take profit on long dollar positions.
Absolutely. And I think we were already sort of cruising to 97, and then you had, it's typical market action, right? I mean, and then that's when the big jump in yields happened, and you came into that morning, it was 2 days back, and you thought, oh boy, I mean, this is absolutely the wrong time. And as it happens so often, that we made a low and then we kind of sort of bounced off those levels because, I mean, there was that buffer because we'd already lost quite a bit, and maybe the inclination was to take some profits here. We'll see, but as Lata tells us, sources in RBI are saying that rates is not the instrument that is on the RBI's mind at this point. No off-cycle meeting to do that as well. We'll take a break. We're back.
Sources close to RBI.
Sources close to RBI. Absolutely. Well, Ixigo management on the fourth quarter numbers and the outlook on the other side. Stay tuned.
Welcome back. Let's get to corporate conversations then. Ixigo, that's the first management on the show, reported a soft set of fourth quarter numbers, obviously on account of two things. One, the impact of West Asia crisis, and secondly, remember, the high base of Mahakumbh in the same time last quarter. So to discuss this and more importantly, what they're doing with artificial intelligence as well, Alok Bajpai, who's the chairman MD at Ixigo, joins us now. Alok, always a pleasure speaking with you. When you started last year, you were fairly optimistic of a near 40% GTV. But you ended this year with a 26% sort of gross transaction value in your overall business. Now that the West Asia crisis saw its full bloom in the first quarter, what's the impact that you've seen in the quarter which is currently on? And by virtue of that, what can you guide for the entire year?
Thank you for having me on the show. I think I want to tell the viewers that, look, travel this year was impacted by a series of headwinds, especially on the flights business, where you saw the beginning of the year, you had Operation Sindoor, then you had the Indigo crisis towards the end of last calendar year, and then last quarter, March onwards, you saw the impact of the Middle East crisis starting to show. I think for the train side of our business as well, there have been a series of policy changes related to waitlist reduction as well as Tatkal access for OTAs. Also, we've seen the fact that there have been changes in how, the system works for Aadhaar verification as well as user re-verification, etc. So I think some of those things were unanticipated from a market ecosystem perspective, but we still managed to grow revenue at 34% YOY. And, we managed to come out with some operating leverage YOY, on the profit numbers as well. So I think we are still pretty satisfied with the resilient growth that we've posted. I mean, especially when you look at the bus business where, year-on-year growth of GTV was 46%, or the flight business where we grew 33% YOY on GTV. I think we are pretty satisfied with our growth in those categories, and we continue to take market share.
Right. You know, we don't doubt that there was resilience and there were a lot of headwinds as well. I mean, one data point I remember during the IPO, I asked you for FY26, will you be able to do 1,200 crores of revenue and 70 crores of net profit? You said probably yes. And despite all the challenges, you've gone ahead and met that. So kudos to you. The question is, what next? Because, you know, the stock price has seen a fair amount of correction, even from the levels at which Prosus bought stake in the company. So the street wants to know what lies ahead for you in terms of growth and plans. If you could give us some forward-looking color on how business is in the current quarter and this year, how is it likely to be?
So I'll talk about three things. You know, the first thing which you mentioned already is AI, right? So I think Ixigo has been at the forefront of reinventing ourselves with AI. And when we say reinvention, this is not just about, slapping a layer of chatbot on top of our app, right? But we've actually gone and put AI at the core of what we do. So we launched Ixigo Next a couple of weeks back, which is in a way a revolutionary AI native interface that essentially makes AI have access to the tools to do things on your behalf, so not just about finding the best tickets for you or finding the best hotels. It can compare, it can check you in, get you your boarding pass. It can actually go and reconfirm the hotel on your behalf. It can actually also suggest, based on your constraints, the best kind of trip. And essentially, the interface marries beautifully with what the app actually does, right? So it's actually an agentic framework that allows you to use voice or chat to actually do things, right? And not just get information. And I think the direction in which we see ourselves going is to become what we call a peace of mind company, right? And we said this at the Ixigo Next launch, that Ixigo was never really an OTA. We were always very, very obsessed about how to solve problems before, during, and after the trip. A lot of utility apps that gave us all the growth on the train side and the bus side. So we continue to be obsessed about how do we solve the travel problems holistically using AI at our core. And we're reinventing the organization. So when we say reinventing the org, we mean that we are putting AI at the heart of how we do things inside the organization, how we ship products out. And I think some of that will be visible in the velocity of things that we ship. Yeah. Some of that will be visible in the growth that comes from here, and also hopefully in the operating leverage line.
Yeah. Alok, hi, morning. Could you just leave us things? I mean, lots of stuff happened, right? And railways is about 40% of the revenue mix for you. And there were a lot of changes there, as you said. So if everything settles down and hopefully, fingers crossed, we don't know when, but maybe this war, etc., ends and oil prices are off, and that shows up in ticket prices, etc. Just give us with some. Is there any way to kind of project put out a guidance for FY27 at this point?
Look, I'll not hazard putting out a guidance, but what I'll say is that last quarter, there was also the aberration of the Mahakumbh built in. Remember, the base last year was exceptionally strong. And even Q1, we were the fastest growing company last year. So there could be some slight base there. But I think the way I look at the summer season evolving, for example, right, demand continues to remain very strong despite fares being relatively super high, right, compared to last year, especially on international routes, but even on some domestic routes. What we are also seeing is substitution of demand. So, we see train bookers who are not able to get seats move into the bus funnel. We are seeing flight bookers who are seeing higher fares move back into the bus and train funnel. Some of that is very unique this year because of the oil prices and how they are impacting airfares. The other thing we are seeing is domestic substitution for people who are looking at international vacations. Some of them are actually substituting those to domestic, and that is a net positive for us because we are a very domestic focused company. I think the headline for us this quarter was that when we went for the IPO in 2024, train was the largest business line for us. But if you look at our GTV for last quarter, flight has become the largest part of our business. Bus has become the largest contribution margin driver for our business. So Ixigo is no more the same company in many respects from a business mix diversity as it was 2 years ago. We're actually a pretty well diversified OTA, and hotels is the next big leg that we are focusing all our energy on. And I think hopefully sometime in the future, when we start declaring those numbers separately, right, people will see the kind of growth that we are experiencing.
Yeah. Yeah, no, absolutely. And your investors would look forward to it. I mean, you had a massive move to about, I think, 330, 340 kind of levels, but stocks come off quite a bit. The market, and of course, the segment as well, because of everything which has been happening, all the disruptions, etc. Just 10 seconds here, Alok. You spoke about AI opportunity. Once in a while, we hear how these AI companies are building out, they want to go into the real estate search side of things, Google, for example, and maybe, I don't know, OTA. Is there any risk which will suddenly emerge one day? Are you seeing anything on the horizon? No or no?
Well, actually, these large language model companies or horizontal companies actually are partnering with us. So we just partnered with ChatGPT. You can actually search on ixigo, confirm ticket and Abhibus and get things done inside the ChatGPT app. So I think we're using it as an opportunity. I think the top of the funnel, some part of the research and planning might move into these, but that was never done on OTAs anyways. That was always done on Google or a bunch of other places. And I think the net positive for us is that in that world, as long as we can put all that intelligence at the core of our app, right, people don't need to actually ever leave our app to find anything else anywhere, because we have all that intelligence on the tab sitting inside our app, which is available inside the large language models.
All right. Thanks very much, Alok. Appreciate you joining us. Good luck. And it's always a pleasure speaking with you. So let's... the ixigo management with perspective. Deepan Mehta is with us, Elixir Equities. Deepan, good morning. Good to have you with us. We were just talking about, I don't know if you heard that conversation. Process, the technology investor, came in, I think, at about 270, 280 levels. Stocks at about 160. Ixigo listed at about 140. Any thoughts here? It's a beaten down name. It's well run. It's got large technology investors out there. Of course, times are tough now.
Yeah, that's it, Prashant. First of all, thank you for having me on your show and good morning. Yeah, I think that, the travel agencies are going to have a tough time because of the geopolitical events. And of course, ixigo has got certain strengths in terms of areas where there is, I think, limited competition and I would say higher growth prospects like trains and buses. But valuation-wise, it is very expensive, and this quarter numbers were a bit disappointing. The growth, whatever came in the bottom line, was on account of other income. But per se, we like the travel and tourism space, and one of the best way to play it would be through online travel agents. But the usual disclosure that we and our clients are invested, the best pick in our opinion is Yatra, where valuations are reasonable and it is focusing more on corporate travel, and that's a new growth engine for them. So compared to Make My Trip, compared to ixigo, and I think there's one more listed player, I think Yatra valuations are attractive and its growth dynamics also are quite superior.
There's some news on LTM. That's LTI Mindtree. They went through a brand refresh, so they dropped the I, so it's LTM now. They've said that they will be acquiring a company called Randstad Technology. It's basically Europe-based, so they have presence in France, Germany, Austria. The enterprise value, according to the press release, is $160 million. The acquired company had revenues of about euro 469 million. So just, once again, putting those numbers out, the enterprise value of the acquired company is euro 160 million, and the acquired company had revenues of 469 million euros. So it seems to be acquiring it at about 0.3, 0.4 times LTM.
This is the recruitment company, Randstad?
No, it doesn't seem like a recruit because they say that it boosts their presence in aerospace, defense, automotive, utilities, VFS in Europe. But it's a quid pro quo deal. So LTM gets the business in Europe, it gets those onshore centers, but in return, LTM will manage Randstad's GCC facility. The only thing is this acquired company in calendar year 2023 had revenues of euro 609 million. In 2024, it came down to 541 million. And last year, it was at 469 million euros. So it's basically come down by close to about 20-odd%. Deepan, can you make sense of this deal for us?
I think, Rima, you put it pretty well, that I just understand what it brings to the table. And I think that a lot of the IT software services companies are going to look for such acquisitions to boost their AI presence or to fill up gaps within their offering, which they haven't got so far. But I still feel that there will be few winners and many losers within the software services space. And I think in a couple of quarters also, it'll become clear which are the companies which are really benefiting and using AI to their most advantage, and which are the companies which are lagging, and where I think there is going to be stress because of too much of overemphasis on legacy systems or such clients.
All right, take that point. Thanks a lot, Deepan. What we'll do is take a short break, come back. We'll continue our conversation with you. We'll also welcome Videsh Thakkar and Shrikant Chauhan for some of their technical trades and the setup for the market. Stay tuned. Welcome back. You're watching us here on Bazaar Morning Call. The Gift Nifty comes up for you. A mild green start. When we started the show, it was about 20 points. Now it's about 50 points. There's a large trade. JSW Cement, 3.88 crore shares, roughly 3% equity has changed hands in a block window. So we'll monitor that. Decent performance coming in terms of numbers for JSW Cement as well. Deepan is still with us. Deepan, while we were discussing a lot of the companies, two results that stood out for me yesterday. One of them was Honasa, the other one was Nykaa. Both of them post-listing, in the years that they've been here, reported the best ever performance, with both companies promising better times ahead. In light of the valuations at which these stocks trade and the fact that they're off their highs, would you look at any of these?
Yeah, absolutely, Mangalam. I think that within the FMCG space, these are going to be the new leaders. And Nykaa, of course, as a measure of disclosure, we have a small investment in it. But Honasa is also on our absolute radar. And this is the thing, that they are in categories which are underpenetrated. They're not into soaps and detergents and hair oil and stuff like that. And they're into beauty and personal care products. And they are establishing brands or tying up with brands, especially Nykaa, where there's high growth. So I think that they are in a nice sweet spot where they can, I think, continue to grow at 25-30% or thereabout, and valuations are coming down with every quarter because of higher earnings. So within the FMCG space, I think these are the two new winners or the two new players, I would say. And we better to invest in these companies than the traditional FMCG companies like HUL or even Godrej or Imami or Dabur. And you see the numbers which have come from the old generation FMCG companies, very, very disappointing. So we have to make that shift from the traditional FMCG companies to these new generation consumer-oriented companies.
Okay, what we'll do is take a quick break here. There's the JSW Cement block deal which has happened. 4.28 crore shares worth 531 crore shares have changed hands in the block deal window. So that is coming. So that's about 3.14% of equity at this point in time. We have a cement discussion coming up in just a bit from now. Deepan, thank you very much for joining us. Good speaking with you. We'll take a break. We are coming back with, of course, the technical trading ideas and Rajesh Ravi on cement as well in just a bit. Okay, welcome back. Mitesh is with us and so is Shrikant with what they'd want you to do as we start this new trading session Friday morning. Gentlemen, great to have both of you here. We've traded 5 days and the Nifty is up a grand total of 5 points. Mitesh, will we get more this today and how to trade it?
Morning, Prashant. Actually, I have been advocating that the markets will consolidate, contract, and we now have a very clearly defined range. Even if you were not working on charts and all, just look at the price movement. 23,300, 250 on the downside, 23,800, 830 on the upside. I think broadly the Nifty is very clearly contracting between these two levels, and yet I think we don't have any signals of a breakout or a breakdown. Most of the volatility indicators that we track are still flat, very sideways, which means that there could be another few more days before some kind of a directional move happens. So for the time being, I've been saying that either avoid the index or trade around the edges, which is that you take a short close to about 23,800 or try to attempt longs as we get closer to about 23,350, 300 zones.
Shrikant, how long do we remain wedged in this trading band? Are you sensing any sort of a breakout? And what's the trading call?
Good morning, Rima. Good morning, everyone. So while looking at the setup, yes, it is very clear that we are in the range, and it's very difficult to say that when it will break. But the way there is a contraction happening and lows are rising, we are of the view that now one thing is very clear, that if we see the market is dropping below 23,400, then we can expect further more weakness, maybe up to 23,000. On the higher side, it is still difficult for the market to sustain and trade higher. Because 23,800, 24,000, all are important resistance level. So in case if there is any deep, then certainly we should look for taking some long bets with a stop loss at 23,400. If there is any higher opening, then it is better to focus more on stock instead of taking any call on index.
Shrikant, so what about stocks?
See, like broader market is doing well as compared to large cap companies. Most of these companies are finding difficulties to sustain at higher levels. So from the broader market, we like Honasa, which was around 360 yesterday. The company has reported strong number. We can see some gap up opening, maybe 5-10% higher. But even at those levels, it's a buy with a target of 400, 420. We are of the view that the stock is forming a very strong technical formation, and based on that, we may even see the levels of 450, which is, we can say, the maximum level that we can see based on its technical pattern. So even with a gap up opening, it's a buy with a stop loss close to 350. The other stock on which we are bullish is Nuvoco Vistas. There also we are seeing higher top, higher bottom sort of series. Currently, the stock is around 328. We are expecting stock to move towards 350, 355, and we can keep a stop loss around 320 for the same.
Mitesh, what stocks would you go with?
I have a mix of buys and sells. On the buying side is Bajaj Auto with the stock below 10,480 for targets of around 11,000. Apollo Hospital is also a buy. It's been a buy earlier as well. Now can be bought fresh with a revised stop at 82.50 for a target of around 84.40. A couple of sell calls on Jubilant Foods, sell with a stop at 445 for a target of 415, and L&T Finance is a sell. Keep a stop at 272.5, look for targets of 256.
All right, gentlemen, we'll come back to you. Let's talk about the big deal in the cement space. So Dalmia Bharat has signed an agreement to acquire part cement assets from Jayaprakash Associates from the Adani Group. The deal is valued at 2,850 crore, which were acquired by the Adani Group under the Insolvency and Bankruptcy Code. So how does this change the competitive dynamics for the cement industry? What it means for Dalmia Bharat? Rajesh Ravi, Institutional Research Analyst at HDFC Securities, is now joining in. Rajesh, morning. Thank you for joining in. So strategically for Dalmia Bharat, this is a positive. It fills the white space of central India because they've predominantly been heavy in South and East Asia. What's your assessment for Dalmia Bharat in terms of valuation, what it brings to the table?
Hi, good morning. Yes, this was a much, Dalmia needed this asset, and they were on the verge of closing the deal earlier when the whole of the JP assets went through the NCLT. And then there was a cloud of uncertainty whether Dalmia would get these assets. Finally, they are able to negotiate the same and get it from Adani Enterprises. So it is indeed a positive from Dalmia perspective in terms of their footprint expansion and their aspiration to become a pan-India player, given that these assets were already operational pre-COVID, and even during the preceding past 2 years, there was some amount of tolling arrangement which Dalmia was doing. So they have a fair amount of distribution, both trade and non-trade in the market, and hence they can ramp up these assets fairly fast. Yeah, so from that perspective, it is sentimentally positive for Dalmia.
Sentimentally positive. And your view on valuations, $67 per ton all in. And Dalmia Bharat also has this aspiration to get to 75 million tons by FY28. What is the roadmap to get the balance? Would you buy a Dalmia Bharat based on this development?
Yeah, so from a Dalmia perspective, our understanding is the factoring in refurbishment and the WHR capex to bring this asset at a decent margin profile will work out to be around $70-75 per ton, which is itself is a decent in terms of acquisition cost. And in terms of the central market is obviously a decent market where players, Dalmia can deliver good numbers. Overall, what we understand is that there will be a intensification of the regional competition because of these assets getting operational from Q2 or maybe Q3 itself. So there is some amount of competition which will further build up in the central market and weigh down margins for all the players in the region.
Okay, got that. What's the Adani angle? Why are they selling part of their cement assets? They could have used it to bulk up their own capacity for Ambuja.
Yes, this is the key question because we were almost, we had taken it for granted that ultimately it will land into Ambuja's portfolio because Ambuja has a lower share of their capacities in the central market, and we were expecting that this will beef up Ambuja's portfolio in the central market. However, we believe that given that Mr. Karan Adani also recently in the call cautioned that given that the cost bloat up, which they have seen in the past 2 quarters, they would look to tighten their cost metrics immediately rather than chasing behind capacity first. And second, we would also believe that, at the acquisition, at the promoter level for Ambuja, given that large amount of borrowing is already there on books, they would not want to further, add pressure in terms of adding capacities. They can do brownfield later on, and their current capacities are good enough to deliver volume growth. So from that perspective, Adani Enterprises would have let go of these assets and generate better liquidity. From Dalmia, which you had asked earlier, from valuation, what we believe that this could largely be valuation target neutral, EV neutral from given that the initial EBITDA increase, additional EBITDA which will come through, the target valuation would get knocked off because of similar increase in net debt because of the acquisition cost.
So for Adani, in the near term, it's prudent, financially prudent. You don't want to increase your, stress the balance sheet at a time when operational costs are already ballooning. But over the longer term, I mean, it's always a tug of war between near term and longer term. So do you think they did the right thing, Adani?
So from Adani, given that they have very strong, Adani Group have very strong project execution skill set, and the current capacities of ACC and Ambuja have a lot of brownfield opportunities across markets. We believe there are, even if the Adani Group has let go of these assets, would not be significantly negative for them. They have one of the assets which is already under their fold, the JP Super, the JP Super assets in UP Clinker, which was under arbitration between Ultratech and Dalmia. So they may look to develop that at some later point in time, and in the near term, they should focus more on sweating up the existing assets with better margin profile.
Right. Rajesh, just before we let you go, beyond this deal as well, over the last month or so, we've gotten commentary from either Shree Cement or even the Adanis. They're focusing a lot more on profitability rather than capacity expansion. And in light of the fact that raw material costs, input costs and freight costs, etc., have increased, do you believe that there is more headroom for cement companies to now go ahead and take price hikes? And how do you view the stocks now?
Ideally, that should be the condition given the amount of consolidation which has happened in the past 3 years. We were factoring in that when the acquired assets acquired some decent level of utilization, companies would focus more on better pricing. And that has not played out materially so far. And given now that the industry is looking at almost 300 rupees per ton of cost inflation, I take this between Q1 and Q2, there has to be a significant realization uptick. We have seen significant price increase happening across other building materials, including consumer durables, building material space, and even in steel prices. However, cement is the only building material product which hasn't seen any relevant price increase, to put it in that perspective. So yes, given that even logistics cost will go up by 20 to 25 rupees per ton, this is an incremental pressure. The industry need to look through and do more price, absorb more cement price hike rather than just chasing volumes.
All right, Rajesh, we'll leave it there. Thank you very much for joining us. There's 4 minutes to go for market opening, and we will see what happens to Dalmia, and we'll look at, of course, Ambuja as well as trade starts. But Paytm block deal has also gone through. 86 lakh shares, about 1.3% equity changed hands. Saif Partners is the likely seller. I mean, Ant has sold earlier. Saif is selling now. 1160 or so is where this is settling at the end of the pre-open session. So that is, I mean, 2 large deals, right? I mean, one is, of course, JSW and the other one is Paytm coming through today. We've got Mitesh back with us with 9-10 calls. Mitesh, what do you have?
I'll go with the buy on Apollo Hospitals and I'll look for a target of around 84.40 over there.
Okay, Apollo did well yesterday. And we had the management, of course, with us yesterday as well. Varun Beverages is what we want to focus on. And there is some important updates here with regards to their tie-up with PepsiCo, what the change agreement allows them to do, etc. Mangalam, take it away.
Well, it's one, the fact that the agreement with PepsiCo has been extended. So that's a positive. The second part is there is an optionality out here. So they've informed the exchanges that the agreement with PepsiCo in India has been revised. 2 major points. One, exclusive arrangement, bottling arrangement has been extended from April 2039 to April 2049. So up until April 2049, there is clarity that these guys will be the exclusive bottlers for Pepsi in India. The second point, that's more important, where they've said that the requirement to carry out no other business than to be the SPV for PepsiCo has been deleted, which means that they can go ahead and explore other consumer categories rather than just being a person who's bottling for PepsiCo as well. So that optionality is something that the street likes. In fact, Jefferies has come out with a note saying that revised agreement should provide the company with flexibility to explore other consumer categories. There have been no details on the plan for their India business yet, especially given the fact that they've entered the beer category in South Africa. But they do view this move positively as it opens up that optionality. So long drawn view for PepsiCo up until April 2049. And then you have this other optionality which comes in as well. So net, it's a positive. The fact that we are also amidst a big heat wave right now should bode well for the stock after it's corrected from the peak.
With no help from you, though.
No help from me. No, actually, yes, I do consume a lot of their zero sugar products, and which account for actually nearly 30 to 40% of their revenue, which is also gross margin accretive. Not only is sugar bad for your health, but it's bad for the company's gross margins as well, because sugar is expensive.
Live a little, yeah, Mangalam.
I do.
Okay, well, I think we've got the first rates come up, and Varun, of course, is up about 2.5% at the end of the pre-open session. But we'll look at that. We'll, of course, the cement space in focus, and so many companies which reported numbers. Nykaa, let's just put that up quickly if we have like a second or two. Put up Honasa, where that is at the end of the pre-open session, how they likely to start. 7% on Honasa, 3% on Nykaa. Paytm is higher, that block's gone through, and of course JSW Steel is the other one, and so many others. Ixigo, we spoke with the management earlier, that should come up as well. LIC, Yash told us his numbers are strong. Max is down about 2%. Oro Pharma, I think the call's on 1.7% lower on Oro Pharma, 1520, and there's more stuff. So we'll get to these individual names, but you get a broad sense of where they start. We'll look at indices first, as we always do, before we go down to individual names. So 23,700 on the Nifty. It's up about 0.16%. The Nifty Bank is up about 1/3%. The small cap index is up 0.7%. The mid cap index will come up as well. And we've got about 140 points, about 1/4% gain on the mid cap index. 1,230 stocks are higher, 400 stocks are lower. It's about 3:1 in favor of advances. So 23,680 on the Nifty is what you have. So it's flattish but slightly higher. Heat map will give you a sense of how the 50 stocks are opening. Trent is up the most. Tata Motors passenger vehicle is up next. Grasim, Maruti are some of the others. And Max Health is starting lower. On the other end, ITC and Infosys are some of the other names. Rima.
Well, Max is clearly the problem stock in the large cap space. Max is open with a cut of about 5%. And here, their share of oncology has declined sharply on a quarter-on-quarter basis due to discontinuation of select chemo drugs for institutional patients. So that's weighing on the company's performance. Ex of that, the company's gross revenues, ex of oncology, was up 15%, but consolidated numbers are a miss. Stock is under pressure. Along with that, ITC, where again, the change in taxation weighing on cigarette volumes, and the street is still unclear on the trajectory of the cigarette volumes, at least for the near term. LTM is reacting negatively to the acquisition. They've gone ahead and announced an acquisition of Randstad in Europe. They will be paying $160 million. But maybe it's to do with the acquisition or the overall IT space, because generally the Nifty IT is in the red, and Infosys, Wipro too have opened with cuts of about 0.25%. Titan, L&T, Cipla, Hindalco, these are some of the other names in the red. On the way up, Maruti Suzuki is being rewarded for its announcement of price hikes of up to 30,000 rupees per vehicle. So that's the top gainer. Tata Motors passenger vehicles higher. Insurance companies, SBI Life up and about, NTPC, Eicher Motors, Adani Group stocks. In the banking names, ICICI Bank and HDFC Bank too have opened up in the green. But on the whole, very quiet and still very much consolidating in that band.
Consolidating in the front line end, but a lot of individual stocks doing a thing of their own. We have Honasa, which is the stock of the morning, up nearly 10% post its best ever quarterly performance that has come in. WeWork India was locked in upper circuit yesterday post numbers, continues to do well, up 7% straight off the bat this morning as well. The Travenews Techs, Ixigo, we just spoke with the management. It was a soft quarter, but maybe the street is looking ahead and believing that maybe their agentic AI business, along with the fact that demand for summer travel is fairly strong, and the stock which has corrected a fair bit as well. They've given them a long rope. RCF, the EBITDA was up 80%. That stock too, up around 5% in trade. LIC is the other one, which is up 4%. Yash told us it was a good set of numbers. Page Industries is the other one. Reported numbers ended about 1% higher. I think the street likes the management commentary that came by in the conference call that reflects in the stock price, which is higher by about 4% after having seen a big outperformance in the recent past for that counter as well. In the F&O space, we have Varun Beverages, which is opened about 2.5% higher on that revised agreement with PepsiCo. FSN Ecom, which is Nykaa, is also up 3% on reporting a stellar performance. And Dalmia Bharat, on account of the acquisition, we just spoke about that, up around 3% as well. So a bunch of stocks doing extremely well. The only one that stands down, however, is Aurobindo Pharma. Ekta did tell us that those numbers were largely in line with expectations, if not marginally better. But the street seems to have, not been as charitable to the stock. It's down about 3.5%. And then we have a big cut on names like EIL and Quick Heal, both of them down 6 to 8%.
There's a lot happening, right, in terms of individual names. And look at MTAR Tech. It's again come up with huge volumes for this point of the day. It was like a super rocket stock. I mean, it is still I guess the best performing stock on the NSE 500 universe. It gave you a quick 10% drawdown, 10% pullback. It fell $1,000, and it's just come up very, very quickly, right back to an all-time high. So it's a new all-time high for MTAR Tech after that 10% drawdown that we saw recently. Page Industries, I think Mangalam mentioned that, is up 5%. Sansera is another one, right? It's gone up like a rocket. It's up 75% in 2026 so far. Close last year was 970. It's at about 2,900 now. The results came through a few days back. 2 days back, it was at just under 2,500. So that is another one, huge mover in that sense. Adani Energy Solutions is up 3% this morning out of that group. It's doing the best right now. WeWork, I think we mentioned it, is up 8%. So that's a large one. VATech Vabag is up 2.5%. We have the management joining us in a bit from now. So it goes. So, there's enough and more activity action. LIC, of course, is up 4% as well. You'll hear from the LIC management a little later during the day as well. Max, of course, is now down 4.5%. Paytm is also down about 3%. Oro and Prestige and Welspun Corp. Welspun Corp has been a big, very strong mover. This year it's up 50%. That includes today's 5% cut after numbers, but it's still up 55% for the year so far. LG India has not really performed. It's down 2% after numbers as well. Rate Gain is down 3%. Datamatics is down 5.5%. So many moves are coming through. Rana Gupta is with us, senior portfolio manager and India equity specialist at Manulife Investment Management. Rana, good to have you with us here. Thanks for joining us. What should we start with? It's earnings season, I think, is pretty much coming to an end. We will get a flurry of numbers as we wrap this up. But how consequential has this earnings season been? Because, we are in the midst of this higher energy impact, and that will only show through in the first quarter numbers and maybe in the second quarter as well. So it's all kind of, the waters have been muddied a fair bit in that sense. How does one make that assessment? Rana.
Hi, good morning. So the results are not quite reflective of the macro environment that we are seeing, because in India, the consumer so far has been largely insulated from the oil price rise and other price rises. But that said, this result is a good indication that last calendar year, the income tax cut, the GST cut, the rate cut that has happened, that has taken impact, and the domestic economy is doing well with inflation so far under reasonable level, which means the economy is quite resilient. And that's why we expect that even if the policymakers decide to increase the oil prices, and we think they should, we think that looking at the resilience and looking at the slack in the inflation, there will be some pain, of course, but I think there is room to absorb that kind of price rises.
Hi. Morning, and thank you very much for joining in. So what's the call now that you're taking on the Indian markets? It's been a painfully long period of consolidation. We haven't done too much. Are you bullish or are you turning a bit cautious now?
So I think there are so many macro variables out here. We have to first outline my base case, and then we can talk about Indian markets. The base case remains that the Strait of Hormuz opens somewhere in mid-June. And even then, the crude price, we do not think comes back to where it was pre-war. So therefore, some of the price hikes are necessary, because right now, because of crude prices, India is having to pay additional about $60-70 billion for crude and fertilizer. Right now, government, the public companies, and to some extent corporates are bearing this. That situation cannot sustain. This has to be passed on, and that is what we think will happen. So that is the best case. That said, I think now we see we'll move to the market. In the market, we see quite a bit of opportunities actually on a sectoral basis. Firstly, the globally linked sectors like power equipment and metal, they should continue to do well because of the global capex that we are seeing in artificial intelligence, infrastructure, and defense. Coming to country specific, we quite like the capital goods sector, and within that, we like defense. Outside that, in the broader industrial space, we like the infrastructure sector, because we think in India, some of the infrastructure plays, the balance sheet is quite solid and cash flow is very visible. So we like that. And secondly, moving on from there, we also like in the consumer space, the consumer retail or platform companies. You were yourself highlighting some of the results that has come through, that consumer retail and platform companies, they continue to gain share in the Indian market. So that is one space, whether it is jewelry, whether it is grocery, whether it is eyewear or beauty products. I think some of these companies continue to gain share, and this is one space we have liked for the long term. Lastly, we see some revival in real estate and building materials as well, because we are quite optimistic on the data center kind of infrastructure and also some of the revival in commercial offices. For once, we do not think that AI will cause significant job losses in India. Of course, Indian IT companies can lose share, but we think the GCCs are there to pick it up. So we are quite constructive on that real estate part and commercial part as well.
Right. So there's a comprehensive list of opportunities that you see in India. What about the travel and tourism portfolio? Because, it was expected to be a big growth driver for the country, but in the very near term, it's facing a fair amount of headwinds. Inflationary headwinds could lead to some sort of discretionary spending being pulled back. Do you think that would weigh in on some of the hotel stocks, some of the travel and tourism stocks?
Yes, sure. I think that's already weighing in. And I think in travel and tourism, currently, I think there will be some pressure for a few more quarters, given we are also expecting or advocating for an oil price rise, which will lead to high transportation cost. So I think, but that said, if one were to take a step back and take a view for 1 to 3 years, we do think the premium hotel stocks are kind of pricing this in, and cyclically, I think there is if you want to look through the near-term pain, I think there could be a good opportunity. We would be a bit cautious on the airlines still because airlines has significant operating leverage. While crude might fall, they can rally, but I think we will be a little cautious. On the other hand, coming to the travel-related portals and technology side, I think this is where if the travel portal is just an aggregator, this is where I think the threat from agentic AI is the most. So again, I cannot say in a blanket view, but we have to understand the company's agentic AI focus and how are they planning to beat that, because this is one area which is likely to be disrupted by Gen AI.
We've seen some strong numbers from these consumer platforms like a Nykaa or Honasa Consumer today. Stocks are racing away on the back of their numbers. Are you bullish on this particular side of the platform companies, new age companies?
Yes, we like the digital companies for a long time. And we like some of the older companies in the jewelry space also, because we treat them as a platform. Outside that, we also like grocery retailing. That is one platform we like. We like the beauty and personal care platforms. Also, we like eyewear platforms. So you will note not all of this is purely tech. Some of this is physical, some of them are digital, some of them are phygital. The point being that because of the superior proposition, they are gaining market share. And that's what we like.
Yeah, point taken. By the way, the market's making a bit of a move now. So 95 points, 23,746 is where the index is now trading at. And it's 1,500-1,600 stocks higher and about 1,000 stocks which are lower at this point. Consumer durables, Rana, any thoughts? Diversified names like LG India. Do you have a view?
The consumer durable will still have somewhat of a difficult time because of the input price rises. So in this case, also earning curves are yet to come. But again, just like I commented on travel, if someone to take a longer term view, we think a diversified white good company can be a good pick for the longer term if one can avoid next 1 to 2 quarters. I will be cautious of consumer durable companies which are narrowly focused on 1 or 2 verticals, because that is where the input cost will still be the most and most impacted by competition. So large, diversified, premium white goods play, we would be optimistic, but there will be challenges for the next few quarters.
What hospital names? Do you have a view?
Sure, I think you can also think of it as a platform business, right? Because this is a cross section from between platform and infrastructure business. So see, what they do is not only they're gaining market share, but once the digital or the physical or the physical platform is built out, there is little fixed cost to service their additional customers. So when they build, they go through pain or let's say stagnant earnings, and when the building is complete, the earning inflection comes. A lot of these platform companies, whether it's retail, whether it's physical or phygital, we have discussed today, we believe that in FY28 and FY29, they're poised for significant earning inflection. Today, I know it's FY29 is a slightly longer term looking, but in 6 months, we will start talking about that. And I think then we will realize the earning power and the cash flows that will come from this kind of companies. And yes, that includes hospitals.
Just put up Keynes, if we will. That's Keynes Technologies. Had a very sharp sell-off. From 4,500, we went to about just under 3,000. And it's coming back a little bit, just a little bit. From the lows, it's pulled back, right? So 29.95 was a low. It's about 3,200, trying to move higher. So 2.25%. Dixon is up today as well, about 2.5% at this point in time. Any views here, Rana?
The EMS is one sector where we have been bullish, and although the stock prices have not really responded in this particular sector, the EMS sector, while the long term remains very good, but the EMS sector, we have to understand, they are going through some transient but significant challenges. If you think of all these companies, the input prices are all linked through copper, memory, and all those gold and silver, which are seeing significant price rises. So this will impact their margins. This will impact, and if not margins, will impact the volume. And these companies operate on a fairly low operating margin number. So therefore, earning downgrade can be quite significant. So this is where I think earning downgrades can continue to happen for the rest of the year. The long-term picture remains, the India's electronics export story remains good. In that case, we have always said that if one were to back any company here, back the ones which has strong cash flows and ROEs. The what has played out in this sector is what we shared with one of the earlier discussion with you. In this sector, because the margin is already low, if someone is buying a company which is growing strongly with low working capital, that can get into a lot of trouble. Because if the operating margin slips, working capital slips, your cash flow situation deteriorates extremely quickly. So that is something one needs to guard against in the EMS sector. But the other companies with stronger balance sheet, with good cash flow ROE, should continue to do well. Again, I think some of the other sectors have cautioned for about 2 quarters. In this case, I think it can continue for 3 to 4 quarters.
What about the financial space? I have to ask you, because most portfolio managers, most investors, etc., they, because of its weightage on the index and because of the long outsized opportunity in India, are fairly sanguine on this space. But in the very near term, there are a lot of headwinds out here as well, right? With regards to the cost of funds, with regards to credit offtake, perhaps because of higher inflation, maybe at some point you get some of the balance sheet troubles as well. Is there a possibility? Where are you on the financial space, and your thoughts on public sector, private sector, NBFCs, the other ways to play it?
Sure, I think that's of course you're right. This is a very large space and one needs to have a view on the sector. Now, per se, I think the Indian financials, the results were also quite good, and we are happy to see that most of these financials, they have made preemptive provisions for for any possible West Asia conflict. So that's a good part. I do not think situation will deteriorate to the extent, and you have to remember my base case that I outlined earlier. We do not think situation will deteriorate to the extent that their balance sheet will be impacted, because all of them have very pristine balance sheet. They have provision cover, and therefore they can withstand, that there is a resilience to withstand some bit of impact. So therefore, we do not think the balance sheet will get impacted. Where it will get impacted is in growth and margins. There we think markets' current estimates are slightly on the optimistic side. And also, if the deposit, the growth cannot pick up, we think credit growth has to kind of come off a bit, and or people will have to fight for deposit raising the rates. So the risk is on the growth and the margins, not so much of the balance sheet. Among the private banks, we like the ones, or even the public sector banks. We like the banks which have a lot of liquidity in the balance sheet and have room to lend. So for example, the banks which have lower LDR and high LCR. So those are the banks we like, where they can continue to support growth. Moving to NBFCs sector is also something that the larger NBFC we are comfortable with, because many of them have raised capital. And having raised capital, they can withstand a rising rate or even a somewhat deteriorating asset quality scenario. Within the entire financial space, the part we like the most is still the financial services. Financial services space is, I think, has a long runway, and there is a lot to like about it. Within that, whether it's exchanges or insurances, those are the things that we like.
Thanks very much for that. And Rana, it's a good chat, detailed chat, and we look forward to our next one. Thank you for joining us here on CNBC-TV18. We put some data out yesterday that after the rules changed from the 1st of April, there has been a rush of buybacks. Nimesh compiled this data, and we put this out on the editor's playbook yesterday, and the numbers are there. I mean, of course, 24,000 crores, but bulk of it from Wipro and Bajaj Auto. But there are, lots of other smaller sized, buybacks which have been announced since. Sign, for example, Aurobindo is there, and so on and so forth. So this is, the initiative, the change in rule has been taken up by promoters and companies in a significant way, and it's just been not very long, I mean a month and a half or so. Bhavesh Shah is with us. He's Managing Director and Head of Investment Banking at Equirus Capital. We also have Devyansh Nasa, Partner EY Parthinan. Gentlemen, great to have both of you here. Thanks very much for joining us. Prashant this side. So Bhavesh, if I can start with you. Is this, as I said, Bajaj and Wipro, of course, accounting for the bulk of it. But lots of, the list is long. Transaction size, etc., is small. What are you seeing out there in terms of companies and interest and just intention to do this? Buybacks after the change in rules?
Hey Prashant, good morning. Good to be here. Thanks for having me. If you step back and look at the capital market environment right now, of course, there is a volatility out in the market. At the same time, a lot of these companies believe that they have excess cash, which can be used better from a capital allocation perspective by giving it back to the investors. That's one. And the second, one of the biggest triggers has been one of the recent changes by SEBI in terms of making buyback more palpable from a taxation perspective, and as well as more market friendly. So I think companies can buy back from the market. I think these sends out very strong signals to the investors that company believe in their growth story going forward, and this can be a very EPS accretive strategy. Clearly, I think some of these companies want to make sure that the investor interest is alive in this counters, and this buyback help in that respect.
So the first thoughts from you, Devyansh, what are you seeing in terms of interest and pipeline from here?
Thanks, Prashant. So, I concur. There have been three major changes which have happened, which has led to this. We talked about the tax reset, which is now it's more clearer, it's more fair, more predictable for stakeholders. There's a cash surplus that is available. But there is another angle that we should think about, and that is the 12% surcharge, which comes on promoter capital gains from these buybacks. And that could somehow change the maths for some founder-heavy companies. So I wouldn't be surprised if some of them pivot back to dividends instead of using buybacks, or maybe go for using cash for inorganic plays instead. But certainly, as we look at it, there have been 25,000 crore worth of buybacks, and it's growing.
So what is, just explain that surcharge point, Devyansh, if you will.
Yeah, so it's basically coming in on the promoter capital gains from the buyback. So if the promoter is selling in, there is a surcharge which the promoter has to pay.
I see. So you're saying that may disincentivize some of the founder-heavy companies to do it and maybe use cash elsewhere.
That's correct.
Right. Bhavesh, any thoughts on this particular point?
So I think, I think essentially what SEBI wanted to make sure is that the new rules are not misaligned from a promoter and a shareholder standpoint. And we had seen instances in the past where buyback was used by the promoters to kind of make gains for themselves and rather than shareholders. So I think what SEBI has done is disincentivize the promoters by participating in the buybacks, including the surcharge. Effectively what it means is, there's a clean way of getting the, buying back from the shareholders into the company. The promoters are not participating in this buyback, and that kind of, from a SEBI's perspective, would lead to a little more transparent and fair process of creating these buybacks.
Yeah. So where is there a sector where we are likely to see more of this, Bhavesh? I mean, just to drill it down.
Yeah, absolutely, Prashant. I think we will see more of these in companies which are obviously very cash throwing. Not very heavy on capex, not very heavy on maybe acquisitions. Of course, you could see acquisitions across, but effectively sectors like technology for sure. So I think wherever they don't have specific needs of capex coming up, some of the pharma companies, wherever there is a cash, we'll definitely not see banks doing this. We'll definitely not see infrastructure companies doing it for sure, because they will need cash for growing their businesses. But it will always be cash-flowing businesses and industries where we will see this action.
Is there like a how much is enough as a strong signal? Is there a science to this?
Great question, Prashant. I think my personal view is, I think it's more of a signal that really matters. It's more of a confidence that the company is exuding to the investors at large. But at the same time, I think the company has to also be cognizant of the fact that what are the kind of signals it is sending out to the investors. Of course, the price is down, and we are there to buy and support these prices. We think this is a great EPS accretive price. But the other is, the signal which the company is giving out to the investor world at large is that I'm not acquiring. There's not major capex. The growth plans are going to be whatever they are organic. So I think the companies need to be very calibrated in terms of what is the signaling and what is the messaging. The investors are able to grasp by way of this method. So.
Bhavesh, I get that. I'm just saying that how much needs to be done so that the signal is strong enough, and it's not a weak signal.
No, I think you can't have smoke without fire. So I think you need to. I think the very difficult. There's no specific science to this, and I think it all depends upon the market conditions as well. But something. If the companies always announce and do nothing, the next time around, investors won't take it seriously. But if something is done, I don't know, there's 10%, 20%, 25%, 50%, very difficult to put a finger on a number. But I think the actions need to follow the talks for sure.
Yeah. No, that most certainly. And I mean, year after year after year, if you look at markets like US, etc., there is, of course, earnings growth. Now earnings growth, because of the last few years, is very strong. But otherwise, during periods of low earnings growth, buybacks have resulted in, large, have accounted for large amount of growth in US. Hundreds of billions of dollars every year in the US over the last, I think 10 years more. So, of course, the size here is much smaller, but we are starting to see some of it. We'll track this space. Thanks very much, Bhavesh, for joining us on short notice. Divyansh, thank you very much for being here on CNBC-TV18 as well. We'll take a break. We're back. The management of VA Bazaar joins us on their quarterly performance. Stay tuned.
Welcome back. You're watching us here on Corporate Radar as we speak. The market is, it's recovering, but at high levels, like we pointed out earlier. It's seeing some sort of resistance. The good part, however, is that the Nifty is above the 50-day moving average. 23,750 is where we are on the frontline index. It's being led by the Nifty Bank, which is higher by about 500 points. But a little over 54,000, we have resistance. It's coming out there as well. So let's see how that pans out. Advanced decline split right down the middle. VA Bazaar, that's the management on our show right now, reported a good set, especially given the likely disruptions from West Asia. The revenues jumped 22%, margins have fallen. Rajiv Mittal, who's the chairman and managing director at VA Bazaar, joins in now. Thanks a lot, Mr. Mittal, for joining in. It's a good performance. The question, however, is what goes on from here on three parameters. One, order wins because of the disruption in West Asia, etc. What's the kind of order inflow outlook that you have? The second part is on execution, because we've been speaking to a lot of people and they say that labor availability, execution remains a bit of a challenge. And then the third part is on raw materials. So cost of execution has increased. On all these parameters, what's your guidance? What's the outlook? What's the setup like?
Thank you, Mangalam, and thank you for having us on your show. I think we are still very bullish. I've said this before, that today we are a multinational company with presences of more than 25 countries. So we are not dependent on one geography. Our risks are spread out, And even when you're talking about West Asia, I think all our execution of the projects are very much intact, and we have been performing well. All our sites are not disrupted. We have adequate workforce to give the desired output, and you can see from the numbers we have exceeded our expectation. So there is no disruption per se in the execution side. On the order intake side, I think we are at all-time high with 17,200 crore plus order backlog. So we are not short of orders. Yes, definitely we have seen some delayed decisions over the last 3 months, but I think it's fine. We are full with execution. It's a matter of time, and water is something where the decisions cannot be delayed beyond a point, both in the drinking water side or in the wastewater side, because it affects directly the people. So we are very much intact, and we have a very bullish order outlook. And last thing about your raw material prices, most of the orders which are under execution, we have already blocked our cost by placing orders both on the construction and on the supply. So we don't see much effect on the present execution. And the new orders, obviously, when we take, there will be a clause to negotiate if there is a continued to be price increase. So there also, we are not very concerned.
So can you put numbers to the qualitative commentary that you've made? What's the kind of order inflow guidance that you have for this year, revenue guidance and margin guidance?
I think, Mangalam, we have given this 3 years back. We don't give year to year or quarter on quarter guidance. We have given a 3 to 5 year guidance, which is, we are very much on it. You can see even this year, revenue guidance are very much what we had given. We had given a 15 to 20%, and we have already achieved more than 20%. And with the kind of order backlog we have, I'm sure we can do much better than 20%. When we will give our next guidance in next year, probably you will see that this CAGR number of 20% will further go up. And same thing on order. You have seen in this crisis, the water has come into discussion. They have been all talking about destroying each other's water assets. So I'm sure each country is going to build adequate reserve capacities of this water. So we see going forward, the governments are going to come up with a policy to have a spare or buffer capacities, which will also help us to build new plants.
And even the margin guidance of 13 to 15% stays despite the inflationary impulse going up?
In fact, Rima, yes, it does. And you have seen even this year, we are both on standalone, we are 14% plus, and on console, we are 13% plus. So yes, this margin guidance will stay and can improve.
Right, Mr. Mittal, good morning. Yeah, water has been in the headlines, water desalination plants and threats to destroy it and whatnot, right? I mean, absolutely crazy stuff. Just one thing, in the Middle East, what is the value of projects under execution on some of the on the plants? I mean, total value in the region, Middle East?
It should be close to about 5,000 crore plus. Don't hold me for this number.
No, we won't.
I'm guessing it will be of that order of magnitude.
Okay. And work on all this has continued through this over the last 2 months.
Yes, absolutely. And in fact, our people are very much there. They're all safe. We have housed them closer to the sites. We have thousands of laborers working. We have not seen any disruption. We just have to be very careful because the countries are very well organized. If there are any alerts, we just put them under safe shelter. Otherwise, the work is going on as usual.
And that point that you mentioned, which is building buffer and spare capacity, have you seen any actual visibility? People picking up the phone and talking to you that this may, or have you seen this come through the pipeline with regards to, just projects being conceptualized or maybe just the idea being floated?
Very much, Prashant, and We have seen it, and people are started talking about it. They have started hiring some advisories who can plan for this reserve capacities to be built. So like they used to build for oil, I think water is going to be the next oil, valuable resource, which is going to be taken care by building spare buffer capacities. 100%. It's only a matter of time.
Right.
Okay. Sir, there were two likely large orders from Saudi Arabia and Kuwait. CNBC had reported it. And you'd confirmed participation in them. Can you give an update on the status? Is it a part of your order book right now, that 17,200 crore, or a part of L1, or when do you expect it to convert?
Rima, first thing, we don't take orders in our order book if we are a preferred bidder. Okay. I think you're talking about two orders. One is in Kuwait, which is $384 million. This is not in order book. We are a preferred bidder. Other one is Hadda, which is a sewage treatment plant, another about 200 million plus. Both are in our preferred status, not in order book. And this should happen very soon. It's just got delayed, as I said before, maybe by a quarter. We definitely see this in second quarter or end of this quarter. We'll see this into our order book.
All right, that's good enough for you to confirm what our colleague Vivek was picking up earlier. You will perhaps get the order and report it to the exchanges by the second quarter. For now, you are the preferred bidder. Thank you so much for joining in, Mr. Mittal, and giving us the update. As you were speaking, we did have some updates coming on MTAR Tech as well. They've bagged orders worth nearly 500 crore rupees from an international entity. The stock has been a buzz for a while right now. Maybe a part of this was what the street was sussing out, and now that we have the reason coming by, the stock continues to hold up high by about 4.5%. 500 crore order coming in.
25,000 crores on market cap now, and it's the best performing stock in the market. By
only Sterlite Tech perhaps has been.
Yeah,
but it's a much smaller company. But this is a stock which has done well, even on days where there is news, no news, and on days where there is some news. But let's move on and talk about Healthcare Global next. Management on the show. The company has seen an operational improvement in Q4. Revenues are up 11%. The average revenue per patient has gone up by 3% and now stands at more than 84,000. Manish Matu, Executive Director, CEO at the company, Healthcare Global Enterprises, is now joining in. Thank you very much, Manish, for joining in. Rima here. Q4 revenue growth at 11.5% is slightly lower than the annual guidance. For the full year, you've met it. But particularly in Q4, it's been moderated. You've spoken about the low-margin business exit, impact of Middle East, the medical tourism, etc. So I get over the medium term, you will get back to 15%. But just as this conflict continues to linger on, do you expect maybe in the first half of FY27, revenue growth will trend below that 15% mark, or have you seen an improvement in April and May?
Hi, thanks, Rima. Good morning. I think in Q1 there may be some impact, but I think by Q2 we'll get over it. So I think we should come back to our guidance of 15% by end of Q2. That's where we feel. And it's not just the Middle East conflict that's impacted the revenues. It's also the fact that we have intentionally decided to pare down the low margin business in some markets. And that's showing up in our increased profitability and margin expansion.
So so for the full year, it's a 15% revenue guidance holds, right?
That's right. Okay. That's right.
What about our margins? Because you have exited the low margin business, which is dilutive. But on the other hand, you're also expanding or opening up in North Bangalore, which will take some time to break even. So I suspect this year it could be a drag on your margins. What's the margin guidance for FY27? And when do you get to that aspiration of 23-24%?
So we've stated, Rima, that in the medium term, we are looking at a 22-23% margin and that going up to about 25% too. I think we are on track to hit that number. Because the measures that we've taken on margin expansion are actually showing us good results. This quarter alone, the margin expanded by 100 bips, almost 100 bips. So I think for this year also, we have baked in the fact that there will be some EBITDA dilution coming in from the new facility. But our margin for a 20% plus growth stays, and we are on track to get there.
Got that. Let's just... good morning and good to speak to you, Manish. So where will all this expansion come from? I mean, asking a hospital company, how will you increase margins and keep increasing margins usually is we're all consumers of healthcare services, so we don't want to pay more. But you got a business to run. Where will this expansion come from, Manish? Since the PE guys came in, will you has everything been done to kind of has the revamp, or whatever you want to call it, scaling back unprofitable divisions and reducing the sprawl? I mean, all that is done, and now you're just executing, or there is more action left?
No, yes, of course. See, it's a journey. It's a journey, and as I've said, margin expansion of 100 bips every year is what we are targeting, and there are several levers, that we are going after. Payer mix is one such a lever, and we've seen great success around it. Price increase in several markets is on the anvil, and that should also help us increase the margins. There is investment happening in clinical research, in new technology, in clinical onboarding, and of course, upgrades in our infrastructure, increase in patient outcomes. So all that is going to add up to increase margins in several of our markets. Other thing you have to realize is that many of our centers are maturing. Clinician productivity is increasing. The operating leverage is something that we are seeing in most of our centers coming in. That all those put together will definitely help us increase the margins. At the same time, we continue to invest in newer formats like daycare centers, newer technologies like MR-Linac in the new hospital that we recently launched, in genomics, proteomics, so that the clinical
Manish,
differentiation that we are known for.
In terms of, the flagship hospital in Bangalore, right? How much is that as a percentage of revenues?
So by end of this year, it'll be about 3% of our overall revenues. So the impact on margins and revenue is not going to be significant. But next year onwards, I think there's going to be a significant scale up.
You've also agreed to exit the non-core fertility business, Milan Fertility brand. You'll get about 37 crore on account of that. That, when you couple with the rights issue that you did, what is the capital deployment plan, and what was the final trigger to sell the fertility business? Why now?
So the trigger really was that it was non-core to us, Nima, and it had been running as a scaled-down version, and we were not able to expand and meaningfully impact that space. And as has been stated, our main core will be to invest in oncology going forward. So it was really a non-core business which we thought was best to divest.
Right.
And the deployment will happen in expansion in the brownfield and greenfield projects, which are coming up this year. We plan to expand by about 200 beds over the next 24 months. And this is the capital that will be deployed for that.
Right. Just a final question before we let you go, Manish. You said that you do have a bunch of levers and you have a lot of metrics that you're tracking for growth out there. So if you could lay some of them out for us in terms of average revenue per patient, average revenue per occupied bed, the kind of growth that you're seeing out here, along with the international business as well. Kenya saw a strong growth. What's the average revenue per patient out there, and what's the trigger here?
So average revenue per patient is twice as much in India there. And that's done extremely well for us. For the year, it's grown 39%. For the quarter, it was at 71%. So I think Kenya is going to be a big market for us. But not just Kenya. I think Bombay, Ahmedabad, Bangalore, Vizag, and Calcutta and Ranchi, I think these are 5-6 hubs that will continue to grow quite rapidly in the next year.
And what are you targeting in terms of payer mix?
Payer mix shift, we've already seen 100 bips improvement in the last couple of quarters. And we aspire to double that in this year.
Sorry, that question on the Bangalore hospital, I think as a percentage of total revenues, you said what's the number?
So it's about 2% by the year end.
No, so the Bangalore flagship hospital revenue.
No, not the flagship. I thought you were talking about the new hospital. Sorry.
No. I'm talking about the flagship hospital. That's got to be much higher.
So the flagship hospital is about 16-17% of our overall revenues.
Okay. And which is the next one after that?
It'll be Ahmedabad.
I see. So just a quick, are there any plans to, kind of grow, because you're present in lots of centers, but you're known in a big way for the flagship, but that's true for others as well. I mean, Apollo in Chennai, etc. But is there kind of plans to grow another center to sort of make it a regional hub kind of a thing, which
Right. Yeah. So that's actually happening in many of our centers. Whether you take Borivali in Bombay, you take Nagpur, Nashik, Vizag. We have 2 hospitals in Vizag, or the Calcutta hospital. Many of our centers are now closing to the 10 crore per month mark or more. Many of the centers are now trending between 10 to 15 crores per month. So I feel the next wave of growth, besides the 2 hospitals that I mentioned, of course, they will continue to go quite healthily. The next wave of growth is going to come from these second rung of hospitals, which will continue to grow in double digits this year and then the subsequent years.
Okay. All right, Manish, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. Thank you. Well, 116 points and markets looking strong. We have Sudeep Shah of SBI Securities with us with a quick check on technical. Sudeep, how do you read it? We are at almost 23,800. Back at 23,800, I should say.
Good morning, Prashant. Prashant, what I feel is that 23,600 now will act as a very important support. Last few days, we are seeing Nifty visiting with this 23,550, 23,600 mark and not convincingly even closing below that. So that is coming out to be a very important support. And on the other hand, 23,830, 23,850 is acting as a resistance since last 6 to 7 sessions. So what I feel is, looking at the volatility index, looking at the way the mid caps, small caps, and select large caps are shaping up, eventually we might head towards 24,000, 24,200 levels. So buying on dips would be my strategy from here on, with 23,550 as a support on the downside.
And stocks?
Morning, Rima. The stocks that we like, there are 2 of them. The first one is Hindalco. We have seen a strong uptrend in Hindalco since last several weeks. And now the stock is sustaining at higher levels closer to 1,100. So here, this can be bought with a stop loss at 1,065. And the targets for the same would be 1145, 1170. The second stock, which is there on our radar, is from the auto ancillary space. It's a mid cap. And the stock is Gabriel India. So here also there has been a strong up move in the last several weeks. Post that last 5 to 7 sessions, there has been consolidation also. And the stock is holding firmly above the 200-day moving average as well as the 20-day exponential moving average since last 7 to 10 sessions. So what we feel is that from here on, around 1107 is where the stock is trading. The stop loss would be 1,065. The targets would be 1150, 1180 on the upside.
All right. Take that point. Thanks a lot for joining in and giving us your views, Sudeep. We'll take your leave on that note, and we'll actually take a short break as well with the news that the Nifty is doing extremely well right now, over 100 points, led higher by the Nifty Bank. On the other side, Manisha Gupta joins in with a focus on the commodities space.
Welcome back. Let's talk commodities. As promised, Manisha is now joining in. Manisha, what are you looking at?
Well, I'm looking at the crude oil prices. It continues to be quite volatile, choppy for the whole of this week. Overnight, we've seen 2% of a decline come in. And for this week, with that decline, we're down by nearly 4% for the Brent crude prices. For this year, though, we're still 70% on the higher side therein. The U.S. Secretary of State Marco Rubio has said that there were some encouraging signs on a possible deal with Iran. That is what the markets are dealing with. But in the meanwhile, you also have statements from Iran reportedly working with Oman on framework for permanent toll system at Strait of Hormuz. This is something that the U.S. does not like, and most of the oil producers also would not want this. So this is where the market seemed to be stuck at this point in time. Also, in addition to that, it is going to be the OPEC Plus meeting on 7th of June. That is what the street will watch out for. The 7 OPEC Plus countries may hike output yet again for the month of July. Though without the UAE, what are those numbers looking like? And the spare capacity that the OPEC holds is something that the markets will be doing maths about. And then there's an estimated 8.5 million barrels per day of global inventory decline that the street is now putting out. We have a similar statement coming in from Goldman Sachs, from JP Morgan as well, suggesting that the decline in global inventories is quite sharp, especially when you look at the average numbers for the month of May. If the transit through Hormuz resumes in third quarter, then the prices are expected to slide below $95 a barrel. The street is also anticipating that by the fourth quarter, there would be some normalization back into the street as well. And that could look at the Brent forecast at around $80 to $89 a barrel therein. But even with that, it does stay above 80 no matter what. IEA, in the meanwhile, also cut the 2026 demand forecast by nearly 420,000 barrels per day therein. So the demand growth for 2026 almost cut to as low as 500,000 barrels perhaps, and that would continue to weigh onto the markets therein. For the prices itself, when you look at the second quarter, the current quarter that we are in, the Brent is averaging at around $106 a barrel. And that's exactly what the markets do believe that we could be looking at the crude prices going forward as well. So when you look at all of those forecasts coming in, take a look at the EIA suggesting that $96 a barrel is where they see the crude prices averaging for the rest of 2026. Now, you have Goldman Sachs talking about $85 a barrel of an average. $100 is what Barclays has put out. Zanalyst talks about a range between 95 to 105 is where the crude prices perhaps will stabilize going forward in this and the next quarter as well. World Bank also has upped its average for 2026 for Brent at $86, and JP Morgan talks about 96. So that forecast or those prices of 60s and 70s that we saw before West Asia conflict perhaps are absolutely done away with. Most average forecasts coming in anywhere between 85 to 105 on the higher side.
All right, Manisha, thank you very much for that. We'll take a break. We are back Indianomics with Lata. She speaks with Anand Narayan and Mridul Sagar on options before the Reserve Bank to defend the rupee. Stay tuned, coming up.